On December 28th, 2020, Elon Musk broke his silence. This is not good. 4 words. That sent shockwaves through global industrial markets. What did he see? That most analysts missed? 48 hours earlier, China had quietly activated something. January 1st, 2026. A line was crossed. 60 to 70% of the world's silver supply, now controlled by export licenses. But here's what nobody's talking about. This wasn't the beginning of the crisis. For 5 consecutive years, 820 million ounces simply vanished. COMEX vaults down 70%. London inventories collapsing. Shanghai at decade lows. Industrial buyers scrambling. And on January 15th, 2026, silver hit $93.52, an all-time record. The question isn't whether this matters. The question is, how many businesses will survive what comes next? Welcome to boring currency. I know, the name says boring, but what you're about to discover in the next several minutes is anything but ordinary. If you've built your career on understanding markets, if you've spent decades watching economic patterns unfold, then you know that the most dangerous disruptions are the ones that appear slowly, then strike suddenly. We create this content for serious professionals like yourself, business owners, entrepreneurs, and strategic thinkers who need clarity, not hype. So if this type of rigorous economic analysis serves your decision-making, I'd be honored if you'd subscribe to this channel. Just click that button below. Think of it as bookmarking a resource you might need when markets turn. And one more thing, I'm genuinely curious, where in the world are you watching this from right now? Drop your city or country in the comments. Let's see how global this silver crisis really is. Now, let's get into what Elon Musk actually saw, and why his warning should concern every industrialist on the planet. On December 28, 2025, Elon Musk did something he rarely does when it comes to commodity markets. He issued a public warning. The message appeared on X, his social media platform, in response to a post discussing China's upcoming silver export restrictions. 4 simple words. This is not good. Then he added a single sentence that cut through the noise. Silver is needed in many industrial processes. For most observers scrolling through their feeds that day, it probably seemed like just another billionaire opinion. But for those who understand supply chains, manufacturing dependencies, and the razor-thin margins that keep modern industry functioning, this was different. Musk doesn't typically comment on commodity markets. He builds factories. He runs the world's leading electric vehicle company. He manages one of the most complex manufacturing operations on the planet. When someone at that level breaks their usual silence to warn about a specific material, it's worth paying attention. Because unlike financial analysts who study charts and projections, Musk deals with physical reality every single day. His factories need actual silver, not futures contracts, not price predictions. Real metal that arrives on schedule so production lines keep moving. Tesla's gigafactories consume silver in ways most people never consider. Every electric vehicle rolling off the line contains silver in its battery management systems, in its power electronics, in its advanced sensor arrays. Solar panels manufactured by Tesla Energy require silver for their photovoltaic cells. The electrical contacts that make these technologies work, they depend on silver's unique properties. No other material conducts electricity quite like silver does. No other metal combines that conductivity with the necessary durability and resistance to corrosion. Engineers have spent decades trying to find cheaper alternatives. They've tested countless substitutes. But when it comes to high-efficiency applications where failure isn't acceptable, silver remains irreplaceable. So when Musk saw the news about China's export restrictions, he wasn't reacting as an investor watching market prices. He was responding as an industrialist who knows exactly what supply disruption means. His concern wasn't theoretical, it was operational. The timing of his statement matters too. This came just days before January 1st, 2026, the date when China's new export licensing system would officially take effect. Musk had clearly been tracking this development. He understood the implications before most of the market woke up to them, and he chose to go public with his concern. That decision alone should tell us something. Public warnings from major industrialists about commodity supplies are rare. These individuals typically handle supply chain issues quietly, through their procurement teams and strategic partnerships. They don't broadcast their concerns to millions of followers unless the situation warrants it. The broader context makes his warning even more significant. Tesla isn't the only company facing this issue. Every semiconductor manufacturer depends on silver. Every solar panel producer needs it. Every advanced electronics facility uses it. The entire renewable energy transition that governments and corporations have committed trillions of dollars to, it all runs on silver. Remove that material from the equation, or even just constrain its supply significantly, and the consequences cascade through the entire industrial system. Production timelines stretch, costs escalate, projects get delayed. In some cases, they become economically unviable. Musk's companies sit at the intersection of multiple industries that consume enormous quantities of silver: electric vehicles, energy storage systems, solar infrastructure, space technology through SpaceX. All of these sectors are silver intensive. So when he says this is not good, he's speaking from a position of direct exposure to the problem. He's watching his own supply chains. He's talking to his procurement specialists. He's seeing the data that most people won't access until quarterly reports get published months later. The reaction to his statement was revealing too. Within hours, the post had been viewed millions of times. Commodity traders began reassessing their positions. Industry publications started running urgent analyses. Because when someone with Musk's operational knowledge sounds an alarm about industrial inputs, smart money pays attention. But here's what makes this moment truly significant. Musk's warning didn't create the silver crisis. It simply highlighted a problem that had been building for years, a problem that most businesses, investors, and policymakers had somehow managed to ignore, until it became impossible to overlook any longer. The question everyone should have been asking after reading his statement wasn't whether silver matters. The question was, what exactly did China just do on January 1st? And why did it trigger a warning from one of the world's most prominent industrialists? On the morning of January 1st, 2026, something changed in the global commodity architecture. Not with fanfare, not with emergency announcements or dramatic press conferences, just a quiet administrative shift that most people missed entirely. China's Ministry of Commerce activated a new framework for silver exports. The old system? Gone. The new rules? Now in force. And with that transition, the dynamics of the global silver market fundamentally altered. To understand what actually happened, we need to look past the headlines about export bans and trade restrictions. Because China didn't ban silver exports. That's not how sophisticated economic statecraft works in 2026. What they did was far more nuanced, and arguably more effective. They introduced a licensing system. On the surface, this sounds bureaucratic and boring. Just another government approval process, right? But the details reveal a different story entirely. Under the new framework, any company wanting to export silver from China must now obtain explicit government permission, not once, for every shipment. And the criteria for who even qualifies to apply, that's where things get interesting. First, companies must prove they executed silver exports annually from 2022 through 2024. No gaps allowed. If a firm sat out even 1 year during that period, they're excluded. This immediately eliminates newer players and smaller operators who might have entered the market recently. Second, new applicants face an even higher bar. They must demonstrate annual production capacity exceeding 80 metric tons, not 79 tons, not a promise to scale up, 80 tons of proven existing capacity. For context, that threshold eliminates the vast majority of smaller refiners and traders in one stroke. The mathematics of exclusion become clear quickly. Estimate suggests this framework affects somewhere between 60 and 70% of global silver supply. Not because China mines all the world's silver, but because Chinese refiners process enormous quantities of material that originates elsewhere. Silver concentrate gets shipped to China from mines around the world. It arrives as raw material. Chinese facilities refine it into the high purity metal that industry actually uses. Then, historically, much of that refined silver flowed back out to global markets. That flow just got gated. In December 2025, China's Ministry of Commerce released something else that clarified their intentions. A list, 44 companies. These were the approved entities permitted to export silver under the new licensing regime for 2026 and 2027, 44 companies, for the world's second most consumed industrial metal after copper. The concentration of control became immediately apparent. Large state-connected enterprises dominated the list, smaller private operators largely absent. The message was clear without being explicitly stated. Beijing would decide who participates in global silver trade and on what terms. Now, China's official explanation for these measures emphasized resource conservation and environmental protection. These are standard justifications for export controls, diplomatically acceptable, difficult to challenge directly. But analysts watching resource geopolitics recognized a familiar pattern. This playbook had been used before. Rare earth elements, tungsten, antimony. In each case, China used similar licensing frameworks to transition strategic materials from freely traded commodities into controlled resources. The progression is always gradual. First, introduce licensing requirements. Then, tighten approval criteria. Finally, adjust quotas based on domestic needs and foreign policy considerations. Silver was now following the exact same trajectory. The timing deserves scrutiny as well. These restrictions didn't emerge from nowhere in late 2025. The groundwork was laid earlier. Policy discussions within Chinese government circles had been ongoing for months, possibly years. The decision to designate silver as a strategic resource, that wasn't made hastily. It reflected a calculated assessment of China's industrial priorities and geopolitical positioning. China's domestic demand for silver has been rising steadily. Solar panel manufacturing, electronics production, advanced semiconductor fabrication. All of these sectors are growing rapidly within China's borders. All of them consume silver. By restricting exports, Beijing ensures that domestically refined silver stays available for domestic industry first. Global buyers get access to whatever remains, if anything remains, and only on China's terms. There's another dimension to this that makes the situation more complex. Silver sits at the intersection of economic competition between major powers. The United States designated silver as a critical mineral. Europe includes it in their strategic materials assessments. These classifications aren't decorative. They reflect genuine concern about supply security for industries deemed essential to national interests. Renewable energy infrastructure, defense electronics, advanced computing systems, all of these sectors depend on reliable silver supply. And now a significant portion of that supply flows through a choke point that one country controls. The market's initial reaction to the January 1st implementation was telling. Physical silver premiums spiked immediately. In Shanghai, physical metal began trading at prices significantly above paper futures contracts. This divergence, it signals something important. It means people who actually need physical silver are willing to pay more than what financial markets suggest the metal is worth. That gap between paper and physical prices, it reveals stress. It shows that availability matters more than abstract pricing. It demonstrates that the theoretical supply shown in futures markets does not match the actual metal that's accessible. Lease rates told a similar story. When holders of physical silver started demanding 5% or higher to lend their metal, that was a clear signal. Historically, silver lease rates hovered near zero. People with silver sitting in vaults were happy to lend it out for minimal fees because supply was abundant. But when rates spike to 5% and beyond, it means holders believe their physical metal has become valuable enough to command real returns. It means they're not confident they can easily replace what they lend out. The 44 approved exporters now occupy an extraordinary position. They sit between global supply and global demand. They can choose where their silver goes. They can negotiate terms that buyers previously wouldn't have accepted. They have leverage that didn't exist before January 1st. And behind all of them stands the Chinese government, with the ability to tighten approvals further if strategic circumstances suggest it's advantageous. This is how modern resource control operates. No dramatic announcements, no overt economic warfare. Just administrative frameworks that shift bargaining power gradually until suddenly the entire market operates under different rules. And what makes this particularly challenging for global industry? China's move didn't create the silver shortage. It landed on a market that was already failing. The silver market had been sending distress signals for years before China's export controls arrived. Quiet signals at first, the kind that only specialists and procurement teams notice, inventory numbers declining a bit each quarter, delivery timelines stretching slightly longer, premium spreads widening in certain regional markets. Nothing dramatic enough to make headlines. Nothing that triggered alarm bells in boardrooms, just persistent, measurable erosion beneath the surface of price charts. Then the pattern became impossible to ignore. 2021 arrived with a deficit. Demand exceeded supply by a margin that shouldn't have been possible in a functioning market. Industry observers noted it, assumed it was temporary, and moved on. 2022 brought another deficit, larger this time. Still, analysts treated it as a cyclical anomaly. Surely production would respond, they said. Surely new supply would emerge to meet demand. That's how commodity markets are supposed to work. 2023, deficit continued. 2024, deficit expanded. 2025, deficit reached approximately 95 million ounces, 5 consecutive years. Each year, global consumption exceeded total production. Each year, the gap between what industry needed and what miners delivered grew wider. Add those annual deficits together and a staggering number emerges, 820 million ounces. That's not a rounding error. That's not statistical noise. That's nearly a full year of total global mine production simply missing from the equation. The question that should have dominated every commodity analysis was obvious. If demand exceeded supply by 820 million ounces over 5 years, where did that metal come from? The answer is equally obvious and deeply troubling. Inventories. Stockpiles built up over decades were being drawn down to fill the gap. Vaults that once held strategic reserves were being emptied to keep production lines running. Above-ground supplies that took generations to accumulate were being consumed in less than half a decade. And unlike oil or natural gas, silver doesn't replenish. Once it's manufactured into a solar panel or electronic component, recovering it becomes economically impractical in most cases. Some recycling happens certainly, but recycled silver only contributed a fraction of total supply. The vast majority had to come from primary mining, and primary mining was failing to keep pace. Understanding why requires looking at the supply-side mechanics that most people never consider. Silver mining isn't like gold mining. About 71% of all silver produced globally comes as a byproduct. Miners aren't primarily looking for silver. They're extracting copper, zinc, lead, or gold. Silver just happens to exist in the same ore bodies. It gets separated during processing and becomes a secondary revenue stream. This creates a fundamental problem. When silver prices rise, primary silver mines might increase production. But byproduct silver, that production depends on completely different economic drivers. If copper prices are low, copper mines slow down or shut down. And when copper mines reduce output, silver production falls too, regardless of what silver prices are doing. The structural reality means silver supply can't respond quickly to demand signals the way simple economic models suggest it should. The numbers tell a stark story. Global silver mine production peaked in 2016 at approximately 900 million ounces. By 2025, production had fallen to an estimated 835 million ounces. That's a decline of roughly 65 million ounces annually. Meanwhile, demand was accelerating in the opposite direction. Several factors drove production downward simultaneously. Ore grades at mature operations were declining. Mines that had operated for decades found themselves processing lower quality material. It takes more energy, more processing, more cost to extract the same amount of metal from declining ore grades. At some point, the economics stop working and mines close. That happened repeatedly across major producing regions. Mexico experienced significant disruptions. Regulatory changes in 2024 and 2025 reduced expected output by approximately 5% in affected regions. Environmental reviews delayed projects, community opposition stalled expansions. The political and social context around mining had shifted, and production paid the price. Russia faced a different set of constraints. Sanctions limited access to capital and technology. Maintenance suffered. Efficiency declined. Russian silver output dropped notably, and replacement capacity didn't materialize. Across Latin America, mature operations reached end of life. Bolivia, Peru, Kazakhstan, significant producing regions all saw output decline. And critically, no major new projects were ready to replace them. The lead time to bring a new mine from discovery to production typically spans a decade or more. Exploration budgets in the 2010s had been modest at best. The price signals that should have triggered massive new investment arrived too late. Even if companies started ambitious exploration programs in 2025, the metal wouldn't flow for years. On the demand side, entirely different forces were at work. Industrial consumption crossed a threshold that hadn't been seen before. For the second consecutive year, industrial applications consumed more than half of all silver supply. This wasn't jewelry or investment demand that could flex based on price. This was demand from sectors where silver serves a functional purpose that's difficult or impossible to substitute. Solar photovoltaic manufacturing became the single largest growth driver. The International Energy Agency projected that global solar capacity would quadruple by 2030. Every solar panel requires silver paste for its electrical contacts. As solar deployment accelerated globally, silver consumption by the photovoltaic sector surged. Estimates suggested this sector alone consumed record quantities in 2024 and 2025, and projections showed demand continuing to climb steeply through the end of the decade. Electric vehicles added another layer of consumption growth. During 2025, EV-related silver demand jumped an estimated 20%. This wasn't just battery technology. Modern electric vehicles use silver in advanced sensor arrays, in high-voltage wiring systems, in power management electronics. As vehicles become more electrified and more digitally sophisticated, silver content per vehicle increases. With global EV adoption accelerating, particularly in China and Europe, this demand vector showed no signs of slowing. Then came an entirely new category that few had anticipated even 5 years earlier: artificial intelligence infrastructure. Data centers processing AI workloads require extraordinary amounts of electrical efficiency. Server components use silver in high-performance electrical contacts. Thermal management systems depend on silver's superior heat conductivity. Power distribution within these facilities uses silver to minimize energy losses. As companies worldwide invested hundreds of billions into AI infrastructure, silver demand from this sector began appearing in meaningful quantities. Semiconductor manufacturing added to the pressure as well. Advanced chip production requires silver in precise quantities for specific applications. As chip designs became more complex and production volumes increased, so did silver consumption. And unlike some materials where substitution is possible, the specific electrical properties needed in high-performance semiconductors made silver extremely difficult to replace. Medical applications, though smaller in volume, were growing steadily too. Silver's antimicrobial properties made it valuable in medical devices and treatments. Food industry applications used silver for preservation technologies. Countless smaller industrial uses added up to significant aggregate demand. The cumulative picture painted by these trends was unmistakable. Demand wasn't cyclical, it was structural. It came from sectors experiencing long-term growth, not temporary surges. Solar expansion wasn't going to reverse. Electric vehicle adoption wasn't going to suddenly stop. AI infrastructure build-out had years of runway ahead. These were multi-decade transitions, and all of them required silver. Meanwhile, the visible evidence of stress appeared in inventory data. COMEX registered inventories in the United States down approximately 70% since 2020. That's not normal drawdown. That's systematic depletion. London Bullion Market Association vaults held significantly less metal than they did just a few years earlier. Roughly 40% of holdings had been withdrawn. Shanghai Futures Exchange inventories hit their lowest levels in a decade. The metal was being pulled from every available source to meet demand that production couldn't satisfy. Perhaps most telling were the lease rates. 5 times during 2025, silver lease rates spiked above 5%. In a market that historically saw near zero lease rates, this represented fundamental change. It meant holders of physical silver were demanding substantial compensation to temporarily part with their metal. It meant confidence in being able to acquire replacement silver at predictable prices had evaporated. Industrial buyers began reporting something even more concerning. In certain markets, readily available physical silver inventory had fallen to just 30 to 45 days of supply. That's not a comfortable buffer. That's barely enough to handle normal supply chain variability. One disruption, one delay, one unexpected surge in demand, and production lines face material shortages. This was the market condition on December 31st, 2025, before China's export controls took effect, before licensing requirements went active, before the world's largest refining hub restricted outbound flows. The crisis was already there, structural, measurable, worsening each quarter. China's January 1st policy didn't create this situation. It simply removed the last remaining buffer and turned a slow-motion crisis into an immediate emergency. January 15th, 2026. Silver touched $93.52 per ounce, an all-time record. A price level that would have seemed absurd just 18 months earlier. But anyone tracking physical market conditions understood this wasn't speculation. This was reality catching up to fundamentals that had been ignored for far too long. The price chart told only part of the story. What mattered more was the growing gap between paper markets and physical reality. In Shanghai, physical silver was trading above $80 per ounce, while COMEX futures contracts lingered substantially lower. This divergence revealed something critical. People who needed actual metal were willing to pay significantly more than what financial markets suggested the commodity was worth. That spread, it's a distress signal. It means the paper promises traded in futures markets don't reflect the difficulty of obtaining real, deliverable silver. It means industrial buyers are competing for limited physical supply, while traders still operate in a world of theoretical abundance. The year 2025 had already delivered extraordinary performance. Silver surged approximately 147%, from roughly $30 per ounce at the start of the year to $70 by December. That kind of move in a major commodity market doesn't happen without underlying stress. And now, barely 2 weeks into 2026, silver had already pushed past $90. The momentum wasn't slowing. If anything, it was accelerating. Industrial sectors began calculating what this meant for their operations. Semiconductor manufacturers found themselves facing a material cost structure they hadn't budgeted for. Silver represents a small percentage of total chip production costs under normal circumstances. But when silver prices more than double in a year, even small percentages become significant budget items. And unlike other inputs where alternatives exist, silver's role in advanced semiconductor production remains largely irreplaceable. The electrical conductivity and reliability requirements in high-performance chips demand silver. Engineers have explored countless substitutes over decades of research. None match silver's combination of properties at the microscopic scale where modern semiconductors operate. Solar panel manufacturers faced even more direct exposure. Silver paste applied to photovoltaic cells represents a much larger percentage of panel production costs. When silver prices surge, panel economics shift immediately. Projects that looked profitable at $30 silver suddenly looked marginal at $90 silver. And with governments worldwide having committed to massive solar deployment targets, this created a serious problem. Either panel prices would need to rise substantially, squeezing deployment rates, or manufacturers would need to absorb cost increases that threatened their margins. Neither option was appealing. Electric vehicle producers confronted similar mathematics. Tesla, the company whose CEO had issued that warning in December, uses silver throughout its vehicles. Battery management systems, power electronics, sensor arrays, all require silver. Multiply modest per-vehicle silver content by millions of units of annual production. And price increases translate into hundreds of millions in additional costs. For an industry where margins are already under pressure and competition is intensifying, this represented unwelcome cost inflation with no clear mitigation strategy. medical device manufacturers, electronics producers, industrial equipment makers. Every sector dependent on silver's unique properties faced the same challenge. Costs were rising rapidly, supply was becoming less reliable, and the fundamental drivers showed no signs of reversing. The industrial response began manifesting in predictable ways. Procurement teams started pre-buying silver inventories where possible. Companies with balance sheet capacity began stockpiling physical metal to hedge against future price increases and supply disruptions. But this behavior, while rational for individual firms, made the collective problem worse. When everyone tries to build inventory simultaneously in a market already running deficits, available supply gets absorbed even faster. Prices get pushed higher. The squeeze intensifies. Financial analysts and commodity strategists began publishing updated forecasts. The range of predictions revealed significant uncertainty about how high prices might go. Conservative institutional forecasts from firms like Bank of America and Metals Focus suggested silver would average between $55 and $65 in 2026. These projections allowed for a potential upside toward $70 if investment flows accelerated. These were cautious estimates from organizations that typically avoid extreme predictions. Citigroup's analysis suggested silver would continue outperforming gold and could reach the high 70s during 2026. Their reasoning focused on the combination of supply constraints and strong industrial demand. UBS revised their mid-2026 target to $55, up from a previous $47 projection. The upgrade acknowledged that supply dynamics had worsened faster than their earlier models anticipated. But other voices in the market were considerably more bullish. Alan Hibbard from Gold Silver published analysis suggesting silver might perform even better in 2026 than it did in 2025. His forecast indicated he wouldn't be surprised to see prices exceed $100 per ounce, potentially reaching $175 or higher. This represented the aggressive end of mainstream forecasting. Philippa Geisels at BNP Paribas also entered the debate with a prediction that silver could hit $100 by year-end 2026. These forecasts remained outliers compared to institutional consensus. But they reflected a view that markets were still underestimating the severity of the supply-demand imbalance. The technical analysis added another dimension to the picture. Silver had broken through long-term resistance levels that had contained prices for over a decade. The 2011 peak, near $50, exceeded. Every subsequent resistance level cleared. The monthly price chart showed 7 consecutive months of higher highs and higher lows through late 2025. This kind of sustained upward momentum rarely appears in major commodity markets without fundamental justification. Technical analysts noted that silver had entered potentially overextended territory by early 2026. Some consolidation or pullback seemed likely before the next leg higher, but the underlying support levels had risen dramatically. What previously represented resistance was now becoming support. The market structure had fundamentally shifted. For business leaders and strategic planners, the implications extended beyond simple price forecasts. This situation represented a structural transition in how a critical industrial material gets allocated globally. Several realities became clear. First, supply chain security now outweighed price optimization for silver-dependent industries. Companies couldn't simply wait for lower prices that might never arrive. They needed to secure physical access to material, even at elevated costs. Second, geographic diversification of silver sourcing became strategically essential. Reliance on supply chains that flowed through China now carried concentration risk that prudent management couldn't ignore. Firms began exploring alternative sourcing from Mexico, Peru, Australia, and other producing regions. But establishing new supply relationships takes time, and available supply outside China-controlled refining infrastructure was limited. Third, material substitution research gained new urgency and funding. While silver remained irreplaceable in many current applications, companies accelerated programs to develop alternative materials or processes. Even modest reductions in silver intensity per unit of production could significantly impact costs and supply security. But bringing new materials from research to production-ready status typically requires years. This offered no near-term solution. Fourth, the timeline for elevated volatility and uncertainty extended further than many had anticipated. Initial expectations suggested the market might stabilize within months, but as the full scale of the deficit and the impact of China's export controls became apparent, strategic planners began working with 18 to 24-month horizons for continued market stress. The geopolitical dimension added another layer of complexity. Silver had joined rare earths, lithium, tungsten, and antimony in the category of strategically contested materials. Resource nationalism was spreading. Chile had moved to nationalize lithium production. Indonesia had restricted nickel exports to force domestic processing. China's moves on multiple critical materials reflected a broader strategy. Western governments responded with their own initiatives. The United States increased focus on domestic mining and strategic stockpiles. Europe accelerated critical materials sourcing diversification programs, but these policy responses required years to yield meaningful supply increases. In the immediate term, industry would need to navigate a market where supply was constrained, prices were elevated, and geopolitical tensions added unpredictability. The European Union Chamber of Commerce in China conducted a survey in November 2025. Results showed that a majority of member companies had already been affected or expected to be impacted by China's export controls. This wasn't theoretical concern. It was current operational reality for companies across multiple sectors. What made this particularly challenging was the lack of quick fixes. Unlike some supply disruptions where alternative sources can be activated relatively quickly, silver's market structure meant adjustments would be slow and painful. Mine development takes a decade. Refining capacity can't be built overnight. Supply chains that took decades to establish can't be rerouted in months. The industrial world was locked into dependence on supply infrastructure that no longer operated under the assumptions that shaped previous planning. As January 2026 progressed, one conclusion became increasingly difficult to dispute. The silver market had entered a new regime, not a cyclical spike that would revert to historical norms, but a structural shift where scarcity, rather than abundance, defined the baseline condition. Elon Musk's warning in December had been more prescient than many realized at the time. This is not good. For industries dependent on reliable silver supply at predictable prices, that assessment was proving accurate. The convergence of 5 years of deficits, declining mine production, surging industrial demand, geopolitical resource control, and collapsing inventories, it created a perfect storm, one that would reshape cost structures, supply chains, and strategic planning across multiple critical industries. The question facing business leaders wasn't whether to adapt. The question was whether they could adapt quickly enough before the constraints became binding on their operations.